Taxpayers and novice practitioners frequently confuse a lien with a levy. While a levy is the immediate seizure of liquid assets, a lien is a paralyzing legal claim against your property. This claim is established under Internal Revenue Code Section 6321. Once filed, a perfected lien attaches to all property you currently own, and it automatically attaches to any property you acquire in the future. The IRS only initiates this after assessing the debt, issuing a formal demand for payment, and waiting 10 days for the taxpayer's failure to pay. The entire weight of the federal government stands behind this action. This federal claim enforces a decade-long financial paralysis, methodically choking a taxpayer's operational mobility. This timeline illustrates the life cycle of a federal tax lien. We start at day 0, when the IRS issues the final pre-lien warning, the CP 503 or CP 90 notice. This opens a critical 30-day window. If that window closes without resolution, we hit day 31. The IRS files Form 668Y, and the lien is legally perfected. At this exact moment, a private IRS tax debt becomes a matter of public record, registered directly in the county where your property is located. Anyone running a background or credit check can immediately search and find this claim. The collateral damage is immediate. You cannot refinance an existing mortgage, and banks will categorically deny new business loans. Returning to the timeline, the taxpayer's credit score typically drops 100 to 150 points the moment that filing hits the public record, and their damage holds. The lien remains active across all 10 years of the statutory collection period until it expires. Halting this unspooling requires aggressive intervention before day 31, or the precise application of statutory mechanics after perfection. The practitioner's primary statutory instrument for bypassing the paralyzing effect of a blanket lien is Form 668WC. This matrix maps out the 3 distinct strategic cures available under this form: release, subordination, and discharge. A release entirely removes the IRS claim from all of the taxpayer's property. A subordination means the IRS maintains its claim, but legally agrees to take a junior position to a new creditor. Consider a business owner who needs a $50,000 equipment loan to expand. The bank will only lend the money if they have first priority over that new asset. The IRS will agree to subordinate its lien to the bank because allowing the business to expand directly increases the agency's overall collection potential. A discharge removes the lien from one specific piece of property while maintaining the claim on the rest of the taxpayer's portfolio. If a real estate investor must sell one property to provide clean title to a buyer, the IRS will discharge the lien on that single house, provided the netted proceeds fund a substantial down payment on the tax debt. Form 668WCYC is merely the tool. Executing it successfully requires matching the precise statutory cure to the client's asset liquidity and operational goals. Filing this form in a vacuum is rarely successful. It must be tethered to a substantive tax resolution strategy. This matrix charts the intersection between the 3 primary tax resolution vehicles and their structural impact on the federal tax lien. Mapping currently not collectible status reveals its primary limitation. CNC suspends active collection for up to 24 months, giving the taxpayer breathing room. However, the public lien remains completely intact on the record. Mapping the installment agreement shows a distinct advantage. Taxpayer maintains their payment schedule. Practitioners must warn their clients of the operational risk here. Defaulting on that monthly payment schedule allows the IRS to instantly refile the blanket lien. Finally, applying the offer in compromise to the matrix clarifies its timeline. Mere submission of an OIC does not remove the lien. Total removal only occurs upon full acceptance and complete payment of the settlement amount. Failure to synchronize these resolution tracks results in frozen vendor lines and a complete halt to business operations. Resolving the underlying tax debt and mitigating the public lien are 2 parallel strategic tracks that must be perfectly synchronized. The ultimate documentary goal of the practitioner is securing the official notice of discharge or release, known as Form 668YD. Acquiring this document requires navigating and formally satisfying a massive bureaucratic apparatus. This timeline tracks credit restoration following the release. Credit scores typically recover 50 to 100 points within the first 6 months. However, the historical record remains visible on credit reports for 7 full years. Taxpayers often hope state-level protections will shield them during this window, but federal tax liens categorically override state homestead exemptions. Your client faces a strict decision tree: sell an asset to secure a discharge, obtain new capital through subordination, or negotiate long-term debt restructuring to achieve a full release. Success depends on the rigorous application of statutory mechanics to restore a taxpayer's financial mobility.